Welcome back to your weekend wealth review. I'm your financial consultant, bringing you clarity for your capital. Last week, we proved that optimizing your big three expenses matters far more than cutting out daily coffee runs. Today, we need to address a silent partner who is quietly waiting to take a massive cut of your future retirement account. That partner is Uncle Sam. And your traditional 401k might just be the vehicle helping him do it. Grab a coffee, pull up your statements, and let's map out your next financial milestone step by step. Most folks treat their pre-tax retirement accounts like an absolute badge of honor. You get a tax deduction today. Your balance grows over the decades. You feel like you outsmarted the taxman. But math does not care about your feelings. Every single dollar you pull out of a traditional pre-tax account in retirement is taxed as ordinary income. Think about what that actually means. You are deferring your tax burden into an uncertain future. When you finally stop working, you might assume your tax bracket will naturally drop. Sometimes it does. Often, it does not. Especially if you build a healthy nest egg. The government counts on you accumulating a large balance. And they have written the rules to make sure they get their proportional share, plus interest on your growth. Let us talk about the math behind required minimum distributions, or RMDs. The Secure 2.0 Act pushed the RMD age to 73 starting in 2023. That sounds like a nice breather. It gives your money an extra couple of years to compound. But here is the catch. When those mandatory withdrawals finally kick in, they force you to pull out larger sums whether you need the cash or not. If your forced withdrawals push you into a higher tax bracket, you are suddenly paying more to the government on your own savings. Plus, those higher distributions can trigger stealth taxes. Like higher premiums on your Medicare Parts B and D. Your traditional retirement account can turn into a cascading tax disaster if you do not plan for it right now. While you are still in your 40s or 50s. Now, let us look at the calendar. Tax brackets are historically low right now. Thanks to the individual provisions of the Tax Cuts and Jobs Act passed a few years ago. But those provisions have an expiration date. They are scheduled to sunset on December 31, 2025. Unless Congress steps in, tax rates are scheduled to automatically jump back up to where they were before. This creates a very narrow, critical window for strategic action. In 2024, the IRS standard deduction is $29,200 for married couples filing jointly. That creates a phenomenal planning opportunity. If your current taxable income is low, or if you are in a transition year between jobs, you have room to fill up those lower tax brackets without getting hammered. Enter the Roth conversion ladder strategy. Instead of waiting to pay taxes at potentially higher rates later, you intentionally pay ordinary income tax today. You move funds from your traditional pre-tax IRA over to a Roth IRA. You take the tax hit now while rates are low and known. In exchange, you lock in permanent tax-free growth forever. Every single cent of future growth belongs to you, completely tax-free. Let us walk through the exact mechanics of how this works in practice. Suppose you retire early at age 55, or you take a sabbatical year with lower earned income. Your regular salary drops to zero. You suddenly find yourself sitting in the 12% or 22% tax bracket. But you have a massive traditional IRA from decades of corporate work. Instead of living entirely off cash savings, you calculate the exact amount of room left in your current tax bracket. Say you have $20,000 of headroom before you cross into the next higher bracket. You convert exactly $20,000 from your traditional IRA to your Roth IRA. You pay the lower tax rate on that specific chunk today. And you repeat this process year after year. Why is this such a powerful move? Because you are systematically emptying out the pre-tax bucket before the government forces you to do it at potentially much higher rates. When those tax cuts sunset at the end of next year, having money already moved into a Roth environment shields you from legislative whims in Washington. You control the dial on your own taxable income. Let us address the most common objection I hear from clients. They ask me, why would I want to write a check to the IRS today when I do not have to? It feels counterintuitive. It feels painful to pay voluntary taxes. But you are not paying extra tax. You are paying the tax bill on your own terms. You are choosing a known, manageable rate today over an unpredictable, potentially punishing rate tomorrow. Think of it like insurance. You pay a small premium today to protect your assets from a massive catastrophic loss later. Except in this case, the catastrophic loss is giving up 40% of your retirement fund to future tax hikes and mandatory distributions. A tactical Roth conversion ladder gives you total flexibility in how you fund your lifestyle once you stop working for a paycheck. Your money should work as hard as you did to earn it, starting with a disciplined look at your tax diversification. Most people only have one bucket of money. A pre-tax bucket. That leaves them completely vulnerable. You need a mix. Pre-tax, taxable brokerage, and tax-free Roth accounts. This three-legged stool gives you the ultimate freedom to manage your tax liability year by year in retirement. Let us tie this back to the bigger picture of your freedom number we calculated in our very first session. Your freedom number is not just about covering your survival expenses. It is about your net cash flow after taxes. If tax rates jump 5 to 10% the exact year you finally stop working, your entire retirement math breaks down. Your safe withdrawal rate shrinks overnight. So here is your homework for this weekend. Pull up your most recent tax return. Look at your adjusted gross income, and find out exactly which tax bracket you are sitting in right now. Then, look at the balance of your traditional pre-tax accounts versus your Roth accounts. Ask yourself if you are building a future tax bomb, or if you are proactively diffusing it. We will pick up right here next Saturday, where we will examine how to structure your taxable brokerage accounts to bridge the gap before your Roth ladder becomes fully accessible. Stay disciplined, protect your downside, and I'll see you next Saturday.